Good afternoon, everyone. Thanks, Cafe Mutual, for giving an opportunity to share my perspectives on the taxation and the regulatory aspects. And also, uh, uh, I'm seeing a lot of people it's typically a post-lunch session, usually needs to be interactive and probably exciting. So I'll keep it as exciting as possible. Typically, tax as a topic has always been dynamic. Every day you always have some new probably ruling, new sort of thought process of the government. Suddenly things change, suddenly things be introduced. So it's always keeping every professional on their toes. And I'm sure with every change in taxes, even as wealth managers, distributors, individuals, all the investors have a say on it has touch points in all the ecosystem. And typically, I think of late, we have seen while the Indian investor profile has been growing definitely over time, uh, over the past 5-6 years, with a lot of movement of people coming in from overseas back to India and having exposure on the investment opportunities outside India, the pool of investors resident in India who want to get exposures to the global markets is expanding rapidly. And as we speak, as we see, while the Indian markets are growing, the global markets are probably growing at a faster rate, which is probably in dollar terms wise, it's a lot more attractive. While India always have its growth story, we always see investors want to sort of diversify their holdings. And every sort of techie, every other new age investor would always want to sort of access to your new age stocks, right? Probably in India, we still have some time to get our new age stocks or access to the new age stocks, while globally, a lot of investors are going out. And that's where a lot of tax and regulatory considerations come in. Now we have a lot of platforms where I'm sure in the morning we would have seen the new age platforms which give access to the global investment opportunities. With this backdrop, to an Indian individual or a resident, to access the public markets, the most simple route is the liberalized remittance scheme route, wherein you usually have access to the overseas stocks and ETFs. Along with the LRS option, you have domestic mutual funds also. Through the domestic mutual funds, you can get access to the overseas stocks. You also have Cat3 AIFs through the Gift City. You also have the global access provider in the Gift City, as well as through the PMS through the Gift City. I'm sure you'll be hearing Gift City a lot through the day, and I'm sure you would have had a couple of insights as well. But going briefly on each of the investment routes to sort of get in, the most simple and probably the easiest route is the direct offshore stock and ETF acquisitions. It's through an LRS where you hold individually, you have access to the overseas stock. But the biggest challenge of late is there is a limit which of $250,000 US. And while this limit has been there for quite some time, it was increased from 2 lakh to 2 lakh 50, and it's been there for almost 10 years now, which means while the purchasing power has increased, RBI, I think, doesn't want significant cash outflow to go outside of India. So I don't think this limit is going to be sort of liberalized anytime soon. But with this, what also happened a couple of years back was they also introduced a TCS, which I'm sure you're all aware that there's a 20% TCS on any remittance outside India. Again, 250K is a remittance limit. Your TCS can be above that. So which means you'll have a cash flow of 300 US dollars. And again, if there's a lot of thought process on TCS also, a planning probably wherein as wealth managers, if you ask an investor invest funds today, there is a TCS you'll have to collect today, but you'll probably get your refund only after the returns is processed, probably after 6 months, 8 months, probably sometimes if there's a tax audit in November next year. So that's TCS planning is somewhere you could probably have your investors, your clients, invest or put it into some liquid funds in Q4 of FY26, wherein you can get your refunds faster. So which means as soon as you file your returns in July or June, so your float is only 3 months. So this is something, a point to discuss or brainstorm as well with the clients. Again, in terms of once you sort of invest, it has to be disclosed in your ITR, and it's probably typical that most of the people sort of declare. But there have been many cases where people who have been outside, coming back to India, have skipped sort of disclosing it. Somewhere with the black money sort of rules, Benami rules, with the and information exchange between countries, the tax authorities across the world are exchanging information. So if any information of this disclosure is not provided in the ITR, there are penal charges. So I think that's something worth to discuss with your client, so that while you always give your investment advice, is it actually demonstrated or disclosed in the ITR is also a critical aspect. Moving forward from a tax rate perspective, from past 1 year, the long-term tax rate has been harmonized, and there was sort of a disparity between non-residents and Indian investors. Now it is aligned at 12.5%, whether it's a non-resident investor gaining capital gains or an Indian investor, it's 12.5%. So it's probably one of the very good rates across the world. Probably developed countries, it can go up to 40%, 20% plus surcharge, local state tax 30%, but India is one of a very efficient tax rate for long-term capital gains. So before this was introduced, many people wanted to keep funds outside, move outside, possibly earn income outside, then try to get it back. But probably with a very efficient tax rate, probably moving or keeping funds outside just for tax reasons has come down. But if you are looking to move permanently, I'm sure there are certain immigration benefits as well. But from a tax, of late, people want to pay the tax and just sort of live with the cost as such. So another interesting thing was, I think globally, apart from listed stocks, a lot of exchange-traded funds, hedge funds, probably complex hybrid mutual funds, and all have been very attractive. And till some time, probably a hybrid instrument or a hybrid ETF may have sort of given a 12.5% tax rate. But unfortunately, any ETF, any gain made on ETF, which is investment outside India, will be taxed at a peak slab rate or the 30% odd rate. So probably it's not probably not really a best outcome. But in India, if you're investing in an Indian ETF, which is hybrid, you still get a long-term capital gains tax rate of 12.5%. But unfortunately, this has not been extended to your outside India investments. Again, from a regulatory perspective, any proceeds which has been liquidated or any investments are liquidated has to be repatriated within 90 days if it's under ODI route. And if it's under OPI, which is called an overseas portfolio investment route, wherein your investment in a listed entity is less than 10%, the period is 180 days.
Yeah. Yes.
No, it's on more than 3 years. For other than shares, it is more than 3 years. So then it will be long term. Yeah. Yes, that's right. 12. That's right.
Yes. That's right. That's right.
So what has been clarified today is a hybrid ETF wherein more than 65% is a specified mutual fund is only which is local. Unfortunately, this clarification is not provided for your outside India ETFs. That's where the period.
Yeah. Yeah. That's right. That's right.
Again, depends on what fund, what is the term, is it an unit which I hold in that ETF? All those aspects sort of come in. That's where your underlying, whether it's a debt, what is the ability, whether it's hedge. So it depends on that, but very, very tough. Direct is very clean, but if it's through a global ETF, that's the anomaly at the moment in some sense. Moving on, I think historically we had the opportunity to invest into an Indian mutual fund, which in turn could have invested in a global mutual fund. Now, with the limits being exhausted, this limits have not been extended and we don't have any other new NFOs coming out of this. So we'll have to see, will this ever be lifted or not? Seems like they want to encourage IFSC investments through the IFSC. So very unlikely these limits could be extended. So the only way to get access is only when there is any redemption, significant redemption is where you can get into an Indian mutual fund which has overseas exposures. But yeah, again, I think this has resulted in a premiums in the local market for these mutual fund units at the moment.
So when you talk about premiums,
Yeah.
it is like ETF versus FOF.
Yeah.
So ETFs, that is trading at premium. Why? Because the units cannot be created,
Yeah.
and therein the units cannot be created, and therein they buy from the secondary seller.
That's
okay. So they can sell that at any price.
That's right.
So therein the issue is there. But when you talk about FOF, I wanted to have a clarity.
Yeah.
FOF they invest in the units which are there outside.
Yep.
So in that there is no issue, right?
So it's not about, you're right, that's not about the issue. The matter of concern is there are limits of how much I can invest, right? Even if I get the cash, I can't have exposure above $7 billion. So I can't invest additionally into that FOF as well to getting an overseas exposure.
So any FOF which invests into their fund,
Yeah.
which is trading outside,
Yep.
not from India.
That's right.
So there also that 7 billion
Limit applies.
limit applies.
Yes. Because FOF in India would typically be an AIF, Cat 3, Cat 2 or through IFSC, right? So they will collect money from Indians. This is a resident investor trying to invest outside in some sense, right?
So that way you are saying
Yes,
that both FOF as well as ETF are not, are therein, I'll say, it is not a good way to invest at the moment because of the premium issue.
Probably because of the premium issue, but independently through AIF Gift City, it might still be possible, but not through outside the IFSC. Currently, they're trading at premium.
Thank you.
Yeah. Again, just coming to the same topic, because I think there's a significant demand but no supply in terms of investment opportunities. I think IFSC Cat 3 is probably one of a good way to sort of get exposures outside India. There are a lot of funds being sort of set up there. Typically, a resident can invest into the IFSC fund through an OPI. Again, the limits of LRS apply. It is deemed as an overseas investment for an Indian, and the same TCS applies. And again, one of the good thing is from a limits, for an individual, the limit is 250K. But if the investment is through a legal entity like a company or an LLP can invest into the IFSC, and the limits are up to 50% of the net worth of the legal entity. So your limit could be expanded if the investor or your client has an LLP or another investing vehicle. Again, from a taxation perspective, it's similar like a trust. Most of the IFSC funds are structured as a trust. So it usually works as a trust, as a pass-through where your beneficial interest is determined, and whatever is the nature of the income of the IFSC trust will flow through into the individual's return also. That is, remittance is only a withdrawal limit. Investment limit is 250K. For example, you are in India, have money in the NR account. Now, if you move to UAE, let's assume hypothetically, you can take out 1 million from the NR account. And from UAE, you could probably, as a non-resident investor, invest anywhere outside. So you can't, if you're a resident, then you have only 250K.
So I would have discussed.
Yeah.
So it is like for an individual investing via gift.
Yeah.
Okay. He's holding resident Indian account.
Yep.
So therein, what will be the tax implication you said?
Tax is a flow through. Whatever as an individual, as a trust unit I have, I'm holding, then it is a normal capital gains 24 months or 36 months if it is more than, if it's not a unit. For example, LLPs could also be set up as a fund there. Then it will be a different period of holding. But capital gains is treated as any redemption or a purchase of that unit is typically treated as on par with mutual funds only.
So 2 year, less than 2 and more than 2.
Yes.
Yep.
So again, there is a limit. As an individual, you can gift only 250K into another person, which could be taken out per annum. So the LRS limits apply for gift also to any other person. So that is two things. I'm assuming your son or the kid is an Indian, right? So typically you can give a gift, okay, like a general gift. You can take it out only if you become a non-resident. If you're a resident, you can get gift, receive gifts, that's absolutely fine. But once you become a non-resident, you can take out 1 million, which means you have to get the gift 1 year before and you become an NRI this year, then you can take out 1 million outside. So that's why it depends on the timing. But if you're a resident, you can't give more than 250K gift to another non-resident. Like from an Indian, can't gift more than 250K. LRS limits apply. When quickly moving to the global markets, I think historically Indian residents could have invested into an Indian AIF, and Indian AIFs could have invested in global entities across the world. But however, the limit of 1.5 billion was exhausted. And again, this has also not been extended. So any AIF today can't invest outside India. Historically, they permitted only if the overseas company has an Indian connection. But this also has been sort of not extended. So this mode or route is not available at the moment. Again, another thing when the regulations were liberalized in August 22 is Indians were sort of permitted to invest into an overseas regulated fund under the OPI route, and the same limits of LRS of 250K and the 20% TCS applies. Again, depends on the regulated fund structure. The capital gains would always be 12.5 on par with other capital gains. And one key thing is regulated funds earlier was defined as units of the overseas regulated fund. Now, even if the fund is not regulated, but the manager is regulated, the individuals can invest into the overseas fund. So that liberalization has been provided. So another recent sort of update, typically there were a lot of interest from family offices and individuals to sort of go overseas more than 400% or 250K. There was a family office framework under the IFSC sort of regime, but of late there was only 1 or 2 instances where an approval was given, but of late IFSC and SEBI RBI are not favoring this sort of family office route. But however, investment through an AIF CAT 1 or 2 set up in GIFT City is still permitted. And again, in this GIFT City, the preference is not concentration of a single investor in that fund. They are preferring a wider range, at least 50% or not more than 50% with one specific investor group or family. So again, if there are 3 or 4 families who want to sort of have a similar sort of thought process, they can sort of collectively set up a fund and sort of invest outside India. I think these were the broad aspects. I think probably a quick overview of all the tax and regulatory aspects going outside India. Happy to take any other questions, but I think I just have 1 more minute. Happy to take the questions. Thank you.
All right, ladies and gentlemen. Okay, we have one question.
Yeah.
If there is a sale of security overseas,
Yep.
not repatriated back into India,
Yeah.
but reinvested back again in overseas securities,
Yeah.
is that first sale transaction taxable in India?
Yeah. Thank you. Good question. So typically, right, a resident and in India, we follow a worldwide global taxation system, not territorial. For example, Singapore says only if the money is realized in Singapore, I will tax it. But India doesn't follow that approach. Any income anywhere across the world you earn, you'll have to offer the tax in India. So to answer your question, if you sell it during a year, if you are a resident for the entire year, that is taxable in India. You have to discharge tax in India. Yeah. With the
TCS and LRS apply in case you end up funding a bank account in GIFT, or will it apply when you end up funding it from GIFT to whatever future investment you end up actually making?
A gift city or just gift?
No, so the GIFT City allows you to create resident accounts as of now. You're not as right, your foreign currency accounts. If I were to transfer money from India using my LRS into that, would the TCS apply at the point of transfer into the account in GIFT, or would it apply when the money goes from that account in GIFT to whichever place overseas?
So currently, GIFT is regarded as a non-resident sort of place for all practical purposes. And the bank account you open also is like an overseas bank's branch. Like let's say ICICI could have a local branch. So any remittance from India to sort of the GIFT City account, I think would trigger a TCS.
But isn't GIFT considered part of India from a tax perspective, and the TCS is income tax, not FEMA?
No, probably a good question, no real answer, probably unless we get a clarification. But RBI thinks differently, tax thinks differently. So your TCS is to control all the remittances. Now, after it goes to the GIFT City, tax authorities don't have control when you invest, what you invest. Probably it's a good sort of mandate to collect it earlier and so that.
Got it. Thank you.
Just one more question. Yeah. So a Indian investment into
City.
Yep.
And then later he wants to use that receipt at the time of redemption for some other purpose, like for foreign education and all.
Yeah.
So whether he can do that, or is it mandatory that he has to repatriate back that money to India and then take a call?
No.
Directly can he?
Yeah. No, I got the question. Thank you. See, again, under law, it says if it is not reinvested, you should sort of get it back. Okay. Now, until 2022, there was no regulation to repatriation back. The repatriation rules did not mandate it. Now the view is, again, there are extreme view which says that every time you sell, you get it back to India, then put the money back under LRS. That is one extreme view. The other view is you get the money realized, you reinvest it there or park it there, that is still fine. So that's where few people are probably, as soon as you realize, put it into a liquid fund outside India only, not keep it as cash. So we suggest don't keep it as cash. Then whenever you have an education requirement or travel requirement or any other investment, you liquidate your liquid investments and then push it back. So there's no real rule at the moment, but this is a practical thing people are taking because...
Yes. Yes. Outside. Real estate, whatever, education. Yeah.
No, this will not work if the money is in NRO. Typically, NRO is for Indian investments, not for outside. So if you have to take it outside, either you have to have a GIFT City exchange account or outside India account or an NRE account. So only then you can expand or keep it outside in some sense.
Yeah. Okay.
It's still NRI, but UK citizen.
Okay.
But his money is in NR.
Okay.
What is the best
So if it's NRO, probably historically it was an Indian earned money. So the 1 million limit which the other person was, it'll apply. So if he wants to take out, he can take out only 1 million per annum.
not take out? I'm asking, which is the best route for investing? Whether can he invest?
In the interest of time, can we please take the questions offline?
Sure. Thank you.
Well, thank you very much, Vishal.